September, equity markets made very strong gains. For example, the FTSE World was up over 7%. This would be a very strong monthly performance for equity markets. Since the start of the month, we saw stronger economic news and continued M&A activity to drive these returns. So in the economic front, we saw better than expected news from China, where business confidence stabilised, which inferred confidence that the Chinese economy wasn't going to slow and have a very negative impact on the global economy. In the US, business confidence was also stronger than expected, and there were signs of stability in the labour market. For example, in September, the non-farm foreign payrolls report showed that less people lost their jobs than the market had been expecting. Also, the data coming throughout the month, such as the initial jobless claims in the US, showed further signs of stabilisation in the US labour market. In August, we had seen that yields were moved to historically low levels in core countries such as Germany, France, the UK and the US. We saw some reversal of this in August. However, it was really a month of two halves. So at the start of the month, the better economic news that we saw out of the US and some of the Eurozone countries instilled confidence and drove yields much higher. For example, in Germany, the 10-year government bond yield moved from 2.08% to a high of 2.5%. But towards the end of the month, it had reversed back some of this move, and it finished the month at 2.27. In September, we saw the US Central Bank, the Federal Reserve, come out and say that it will use quantitative easing if necessary to stimulate the economy if the US economy deteriorates further. This put pressure on bond yields again, which led to the decrease that we saw in the second half of the month. Quantitative easing, firstly, is when the central bank comes out and prints money, and in this case it will buy US government bonds. So by buying US government bonds, it pushes the yield of the bond down, which obviously leads to a lower interest rate for the consumers who have quite a lot of debt in the US, and hopefully spur economic activity in that way. It leads to a weaker currency in the country that is undertaking quantitative easing, which in this case is the US. We saw this in September, where the euro rallied against the dollar over the 130 level, which is a level that we hadn't really seen since the start of 2010. Also, it leads to more liquidity in the banking sector, which can help banks to increase lending to consumers and help economic activity in that way. And sometimes this liquidity also filters through, where we get an increase in asset prices. Irish bond yields moved higher in September as a result of continued concerns over the banking sector in Ireland. For example, the spread of the Irish government bond over the German 10-year government bond moved to 4.4% versus the 3.7% that we had seen at the start of the month. Even though the government was successful in selling 1.5 billion of government bonds in the auction, it did have to pay a very high price for this. Also, we saw that yields moved out after the auction, which would be a further indication of the stress in the Irish sovereign market. The banking sector also provided further clarity towards the end of the month, which did lead to a lower of the yields for the Irish sovereign. So the government announced that in total it will inject 50 billion into the banking sector. Although the numbers that were announced for Anglo-Irish Bank were expected, the numbers for AIB and Nationwide were higher than expected. This will have an impact on the government going forward. So firstly, the debt to GDP number is likely to move over 100%, which is a number that we wouldn't have seen since the 80s in Ireland. Also, the deficit to GDP for 2010 is likely to be 32% of GDP, which would be a very, very high number. And it also has an impact on the government's plan to reduce the deficit to 3% by 2014, and it is likely that the government will have to take more out of the economy than the 3 billion that was expected in the 2011 budget. The outlook for equity markets going into October is a little bit uncertain. For the entire of 2010, we have seen equity markets have been really trading in a range. For example, the S&P 500 has been trading really between 1050 and 1150. At the moment, it's about 1140, which is to the higher end of the range. We think for equity markets to break out of this range, it would need much stronger earnings news and economic news. The earnings season in the US is starting in the middle of October, and we think that earnings for the US companies will have to be stronger than expected. Going into the earnings season, the news hasn't been as positive as we would have expected, as we've seen some negative pre-releases. There are also some concerns about the 2011 earnings number, and if that is to be revised down further, it could be a further headwind for markets.